Okay, testing, 1, 2, 3. It's Friday, the 12th of March, 2021. Let's go. Good morning. Let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Good morning. My name is Wayne McDonald. I am a currency trader just like you, and today we're going to cover technical and fundamental analysis, the overriding goal of helping you put together trade plans throughout this beautiful New York trading session. Ask questions, get involved, write things down, leave comments on the recordings. You should document what your key takeaways from today's meeting. Document them in the comments section below the recording, because therefore in the back office of YouTube you can search your comments and pull up specific videos based on the things that you learned and want to review. So that's a way that you can create a long-term archive. Treat each other with dignity and respect. Keep your comments professional. And I think everything's going to be golden, right? I'd like to thank Traders Way for being part of our community as well. When you decide you're ready to trade real money, please consider tradersway.com. If you open up a demo account today, then you're giving them an opportunity to earn your loyalty and respect. So when you get to that point, you already found someone that you trust like I do. So tradersway.com. Thank you. So what's going on in the world? We had a lot of dollar weakness yesterday and the equal and opposite reaction today as people adjust to the new world order, so to speak. So very often after a big day, you have a small day. All right, fine, cool. But could just be a wave in the ocean of fundamental trends. So anyways, we have to deal with that. Simple enough. Aussie got some strength there. Euro sort of recovering, which is funny because remember this whole new thing that Christine Lagarde is doing is to weaken the euro. And of course, as soon as she announces the new policy, the stupid euro strengthens. Kitty cat red hot. Yen very weak. So that's good. That's good. Pound had some, gave some up. Okay, Kiwi was weak, now it's strong, now it's weak again. Swissy all over the place. So, looks like sort of a pause. Doesn't it? Seems like a pause. Right, it's got more pause than a dog kettle. All right. Let's start with some commodities. Okay, looking at oil, this is the plan from earlier in the week. We started it on Monday, actually. By Wednesday, we were at entry. Here we are Friday, and we're like, meh. Okay, out there somewhere. It's kind of not out there. It's just, just. Anyway, so we're halfway through. Are we going to 70? Are we going to 70? Is that what you think? Well, if we're on our way to 70, there's still like 400 pips. Looks like 71 might be the number, so there could be 500 pips in it, 600 pips. By pips, it's, well, I'm just, again, equating it down to dollars, really. So, you know, that's good money anyways. Think of it as a 400 pip euro dollar rally. All right, so there's some juice. There's some meat on this bone still, but nice entry and no follow through. Okay. Cool. Taking a look at on the Brent side, what is it doing? And it's about the same, right? Decline, gone. Same time, same place, different currency. Or it's oil, but it's different oil, technically. So anyways, so here we are now. So it all depends on whether you think there will be a step up next week. A step up would look like this. Okay. And it's already stuck at 70. So if Brent can't break through, don't expect WTI to get to 70. You're going to need a breakthrough on Brent. Bitcoin is done for the week. Has some room to breathe here. The target for Bitcoin is $71,500. We knew that 12 days ago when it was down here at 45. And it's working its way. It's working its way. Should be done for the week. If you're a bull on Bitcoin, there's two things this is probably what you're stinking. Okay, that's probably what you're stinking. Cool. Take a look at Goldilocks. Goldie. Holy Goldie. Okay. What do you think? Is 17 our bottom? If you combine your fundamental analysis of the demand for gold, you might say, well, this is a pretty good price for gold. If you're looking at the value of the dollar, you might say, well, this is a pretty decent time to sell the dollar. So there might be a couple of things going on in your mind. I don't know what you're thinking. But maybe 17 is a decent price. I don't know. Okay. I guess it would look more like this. Okay. As far as monthly, I guess you could call it an S1R1 month. So the best you could hope for this month would be 18 and some change, and then higher up next month, probably on the way back to 2000. Okay. So what do you think? We're talking about $300 on gold, maybe. Okay. Comes down to whether you believe in any sort of seasonality and future demand for gold. Remember, gold is used for a lot of things: jewelry, dental, electronics. Okay. Yep. Well, Peter, if you want to look at the rise in treasuries, remember that actually started in April when the 10-year T-note paid 0.5%. Now it's over 1.5%. So now that the media is into it, they're like, oh, look at that. Interest rate, treasury yields are way up. Well, they're up 300%, but no one was talking about it in April, May, June, July, August, September, October, November, December, January, or even February. But as soon as the dollar gets strong in March, they're like, look how strong the dollar is. It must be those treasury yields. And people are freaking out about treasury yields, except we knew the dollar was going to do this way before anyone talked about treasury yields. So now that treasury yields are up, now they want to talk about that. If you want to look at it from a true academic point of view, it does change things. And what it does is it changes the discount rate. Not the interest rate charged at the discount window. That's a Fed policy issue. But look at it from a finance issue. Okay? So like, if you're going to do like a pro forma cash flow statement, discounted cash flow statement, how should I do this? You should say money paid to you in the future is worth less to you today. Or right? So let's say how about this? You lend me $1,000 and I say, I'll pay you in 1 year. You're going to charge me an interest rate. Okay? You say, okay, how about 5%? I'm like, okay. What if you lent me money for 5 years? You might say, woo, gee whiz, I might need that money in the next 5 years. Plus, I could probably just save that money or invest that money over the 5 years and earn more than the 5%. Okay? And what it does is it changes the time value of money. So you might want to look at that, the time value of money. And if you could just put, okay, if you could put whatever money into a treasury that earns 1.5%, okay, it'll change your process of what will money be worth in the future based on like alternatives, like the opportunity cost, right? Your opportunity cost will change. You're like, I'll lend it to you for a little while because 5% is okay and I like you and I'll lend you the money and it's good cause or whatever. But over the course of time, you could say, well, I could have just invested here over that period. So someone might change, and we call this the discount rate, and they might say, well, you're gonna have to pay me instead 6.5%. Okay, and this is important. Anything in the future. So you're talking about like this is really important in real estate, for example, because you're talking about rent you're going to collect in the future. Okay, this is very important in bonds. So, like let me try to hit this again. I know I'm not doing a good job, but let's say you put $5,000 into a bond, okay, and every year you earn $100. Plus, you still have your $5,000 bond or treasury that you get back at the end, right? So the way you handle it is year zero, right? You have negative 5,000 cash flow. In year one, you have 100. Year two, you have 100. This is cash flow now, 100 in. Plus, this is a negative number. Plus number, 3, 4. And then on the fifth year, at the end of the fifth year, at the end of the fifth year, see, I can't talk and do math. At the end of the year, you get your $100 plus your $5,000, right? So your fifth year, you get $5,100. Okay, there's your cash flow. Okay, you're out 5,000 today, so you earn 100 in a year, 200 in a year, right? Another 100 in this 2 years, another 100 in 3 years, another 100 in 4 years, and then on the fifth year you earn $100 plus you get your $5,000 back. Okay. Now the question is, what is 5,100 worth to you today if you have to wait 5 years to get it? Now you could say, well, it depends on inflation, right? Because the value of your currency could diminish. The purchasing power of your currency could diminish, which is called inflation. So like $5,100 in 5 years might only buy you $4,700 worth of stuff because prices went up. Okay? So you're like you get your 5,100, but it buys you less, right? You could have also invested it somewhere and got a higher return, but you might have associated some risk like that. Or if you had it in the stock market instead of buying this treasury, you could have made 5% a year instead of this number, right? Or 10% or 20%. Okay, so you have to say, well, if I have to wait 5 years to get my money back, I have to discount what that is worth to me, and that number is that discount rate, okay, is an opportunity cost, really. They don't call it that, but it's an opportunity cost. It depends on what other opportunities you had to use the 5,000 with. Okay, you might have had to take a little more risk, but you could have performed more over that period of time. And so everyone's discount rate is slightly different. So when you're working in finance, right? So I have a background in finance. So when you're working with someone that's building financial models, one of the first things you ask, you're like, well, what's your discount rate? Because my discount rate will be different from yours. Yours will be different from theirs because we have different opportunity costs. Okay? Now, if we're talking about 5 million, you could say, well, right, I can give you, Forex trader, 5 million to trade with. What kind of return are you going to get me? But that investor could also say, well, I can buy a $5 million apartment building. Now, the cool thing is the 5 million is only 20% down, right? So with some leverage, right, all of a sudden they're buying a $20 million or bigger or smaller, whatever, but through, getting the bank involved, they can buy a big piece of real estate and say, well, I'm going to earn 15% on my real estate, and it's quite stable and all that kind of stuff. What kind of return will you get me? And you say, well, I can do 30% a year. I believe my track record shows I can do 30% a year. And now they're going to say, is the additional risk above and beyond the real estate, right? Is it less than double the risk? Because then you'd get a risk-adjusted return that's better, and all of a sudden they say, okay, I'm going to discount what you say you can get me by 15% because I already can get 15% with my money. But you can do 15% above my 15%. So they might consider it. Okay? So that discount rate is very different. Now, very often, when you do things like I said yesterday, the expected return for a stock is equal to the beta. No, hang on. I always get this one right. The risk-free rate of return plus the beta times the expected return of the market, okay, minus the risk-free rate of return. Okay, what is the risk-free rate of return? Is it the 1-year Treasury? Is it the Fed funds rate? Is it the 10-year T-note? Is it your opportunity cost? Okay. So if very often a financier will say the risk-free rate of return, okay, you'll have to declare this. Like, well, what's your risk-free rate? What's your discount rate kind of thing? Your risk-free rate of return, you're going to say, well, we're going to use the 10-year T-note. See, someone else might use something else. So you have to ask, well, what's your risk-free rate of return? Oh, we're using the 10-year T-note. So a year ago, it was 0.5%. Now it's 1.6%. So when the model, right, when the risk-free rate of return is going up from 0.5% to 1.6%, it changes the result of the expected return of investing into a stock. Okay? The numbers change. And so when somebody says, well, what kind of impact does the change in the spike in treasury yields happen? Well, by the way, here's my point. I don't think there was a giant spike. I mean, there's been some volatility, but I don't think there's been a giant spike in March in treasury yields when they were already up 300% for the year. So, like, if there's a 5 or 10% move in the bond market in March, and they're freaking out now that this is all about bond yields, I'd argue and say it's not treasury yields, son. They're already up 300%. Why weren't you freaking out 6 months ago when they were double? Why weren't you freaking out, way in the past? What's happening now? The dollar strength is what's freaking people out, but we knew it was coming. Dude, we were looking at C going, oh, here comes the dollar. I mean, we could see it coming for miles, right? So they're trying to say, now that the dollar strength showed up on their doorstep, what the hell created that? And somebody said, I think it's the bond yields, right? And things did freak out. There was a lot of volatility a couple of weeks ago in these treasury markets, but one of the reasons is it changes this. It changes like this cap M, where you're trying to say, well, what's the value of a stock? Or it would change your discounted cash flows, right? Okay. Right? I was trying to think of, like, how would you do? You do the future value over, right? 1 plus I to the n. So we'll call that year 1. Let's change n. We'll put this 1, okay, plus the future value over 1 plus I 2 plus, okay, this is the incoming cash flow over 1 plus I to the 3, and then you do this forever, right? So it's like changing I. If there's a change in interest rates, okay, and you're figuring out the future value of an investment made today, but the money you get out in the future discounted for your opportunity costs or your borrowing costs or whatever, if inflation goes up, if interest rates go up, how does it affect your money 3, 4, 5 years, 20 years in the future? Okay, that's your present value calculation, right? So it's like, if this I is attached to the 10-year T-note yield and I is going up, it changes the value of money in 5 years, and people might adjust their event horizon, if you will. They might adjust their risk tolerance. They might see, when money was free, people might be willing to take risk. If their borrowing costs go up, and like this present value calculation you might do if you're a real estate investor, because now you're calculating if interest rates go up or the cost of borrowing goes up or whatever, if I goes up, you'll actually be earning less money in 5 years. And so you say, well, I might pay less now for an apartment building because my costs or my risk-free rate of return, because the I is very similar to a risk-free rate of return, that you will pay less now for an apartment building. So people might say, because interest rates are going up, some of these stocks will be worth less because their risk-free number is going up. But it wouldn't create a crash in one day. Okay? That it wouldn't like kill the market all in one day. Oh my God, did you see we went from 1.3 to 1.5. It's all over. You're like, dude. A, we're already up 300%. No one was freaking out about that. And then B, dude, are you crying about a 1.5% 10-year T-note? What are you talking about? It's going to be 4.5. This is laughable. You should get going. Borrow as much cheap money as possible and put all that money to work. See, when you borrow money to invest, if you borrow cheap money for 1.5% and invest it and you're earning 5% a year or 10% a year, you're putting your money to work, and now you're making money on money, where in 5 years, you'll look back and say, oh my God, I could have borrowed money for 1.5%. I mean, think about it. Some people are carrying 20% like on their credit card, right? People they buy stuff with the credit card and then they don't pay off I don't understand why, but they don't pay off their credit card bill. And they're being charged 20%. And then you can borrow money on a 10-year T-note for 1.5. Like, you could pay 1.5 on that, right? And why would you pay 20% borrowing money on a credit card? Doesn't make any sense. But what if you invested the money now, and now that's what a carry trade is, by the way. Okay? If you could borrow at 1.5% and then invest it somewhere and earn a higher yield, you're earning 5%, you're clearing a profit, right? And so as these numbers change, the people making these investments will actually kind of like earn less because you have to pay more over time. And then they'll say, well, if I'm not going to earn this big number return, I'm not willing to take the risk because I need the big number to compensate me for the risk. So when money is free, you'll take big risk because your costs are so low. But as it goes up, you'll say, well, I'm only earning 5% on this deal, but based on this risk, I could probably earn 4 or 5% on this other deal with less risk. You see? And it changes, right? This changes the investment frontier, if you will. That changes the decision-making process. But I do refute that you see on the news interest rates on the 10-year T-note suddenly go from 1.4 all the way to 1.6, and suddenly dogs are living with cats, the sky's falling, the whole thing's over. And I'm like, no, that's not true at all. Okay? That's not true at all. It's seasonality and people don't understand it, so they look to the shaman banging his stick and you know, making sounds with the seashells and his tiger teeth. Woo! Right? No, it's seasonality, bro. Okay. So anyways, I wouldn't freak out about it if I were me, huh? Cool. Cool. Did I lose anybody on that? Just remember, all the inflation we're seeing now is derived from having no deflation in the past, or deflation or disinflation in the past. And next year, because the numerator and the denominator will change, or more particularly the denominator will change, and we will be totally, absolutely back to very boring, very slow rates of inflation and growth. But we'll have huge numbers this year as a consequence of having terrible numbers last year. So if I gave you a 5-year outlook, I'd say the 5-year average is not going to change at all. The only thing that changed on the short run is the math, and if you don't understand the math, then you'll be freaking out. And I'm surprised how many people freak out. Okay. All right. Let's do Swiss franc today. Oh. Johnny's like, Bueller. Okay. Well, Spencer says, would that kind of analysis impact gold? Well, gold doesn't pay you a yield. So, you know, like if you own an apartment building, it gives you income, right? So, like, let's say you buy an apartment building and it's 100% vacant and you decide not to put renters in it. You could put renters in. If you sell it to someone else, they could put renters in, but you just decide, nah, I just want to own it. I don't want to rent it. So you own this piece of property, and in 10 years, it'll be worth more. That's asset appreciation. Now, it might be because of inflation, so it's fake appreciation and all that kind of stuff, but we'll just say real estate in general goes up, demand for apartment buildings goes up, the population goes up, the economy is decent, so, you know, the demand for this asset will go up, and you could probably sell it for more. But that's asset appreciation. That's all gold will do. It can go up, it can go down. Okay? And if you own physical gold, you have to put it in a vault and pay rent, so you actually get a negative yield on your physical gold. Okay? Now, the cool thing about real estate over gold is that you can rent it out, and now you have income. So now you have the value of that income coming in, plus it'll go up in value. So there's income plus, right? So we're talking, but I think what you want to look at for gold is more of a, demand for based on an increase of consumption globally. So you want to look at the C inside of GDP. And then on the probably, you know, they say gold is the anti-dollar. Well, a lot of people buy gold because of inflation. Okay, fine. I would just do it if you happen to think the U.S. dollar is weak, right? So trade it that way. Okay. All right. So let's take a look at Kitty Catty, Silly Sally. Walks to town upside down. Boop, 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 boop. Boop, 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 boop. Boop, 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 boop. Boop, 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 doo. Ba, 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 ba. Ba, 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 ba. Do, ba, do, do, do. I can remember everything, but I can't tell what's true or dreams. Deep down inside, I feel my screams. The terrible silence stops me. How you guys doing? Still with me? Good. All right. All right. We are hitting monthly targets. On the first hour, or let's say the first day. Well, yeah, the first hour of the first day of the month, we were at a buy. And since then, every single day it went up. Well, this one day it didn't go up. Cool. And now we are about halfway through the month, and we are about to hit the aggressive target for CAD Swiss franc. Yeah, Victor, it's typically acts like a funding currency, but it's decoupled in the last several years, probably to do with its fight with the European Central Bank. So, yeah, you're going to have to do your own research on that one. It's an interesting but complicated situation. But typically, historically, and the way I still look at it, is it's a funding currency. Okay? Coolio. So right now, what this looks like is okay. Is that? That's the target. All right, how about this? Let me answer a question with a question. Victor, who is Switzerland's largest trading partner? Who buys most of Switzerland's products and services? Who do they trade with most? Lewis says making a killing on Cat Swissy. It's only up like 300 pips, so you shouldn't be making a killing. It's only 300 pips. But let's go back to the question. Victor, who is the largest trading partner for with Switzerland? You don't know? I mean, dude, come on. Think about it. Grab a map and look where Switzerland is. Okay. Okay. And then ask, once you find out the answer, okay, once you find out the answer to that, does Switzerland, is it an importer? Is it an exporter? Does it want a strong currency? Does it want a weak currency? And then what would the central bank do to create that type of currency. Okay, so I just wrote all the things down. Go. Okay. Go find the answer. Who do they trade with? Do they import from that trade partner, or do they export to that trade partner? And based on import-export data, do they want a strong currency? Do they want a weak currency? And what policies would the central bank enact to create the results they want? And if you can answer those questions, you'll be in a far better position fundamentally than you are now. Okay? Yeah, absolutely. Because, I mean, dude, I can give the answer. It's not a problem. But you want to learn and you want to be the expert, that's what you should do. And you should love it. Smile the whole time while you're doing it. Okay? And when beautiful people look over your shoulder and say, Victor, what are you doing? And you say, well, I'm studying the monetary policy of the Swiss National Bank in relation to its trading partners so I can invest. Lamborghini Mercy. Your girl, she's so thirsty. Yeah, all of a sudden, there comes the Lambo, and pretty people admire you. I like Victor. He crazy. Okay. Cool. We'll take a look at Aussie, Swissy. Lamborghini Mercy. Okay, Aussie, Swissy. On the first hour of the first day, boom! It's long and gone at the price of 0.70000000000. What the? Yeah. Oh, for sure, eh? For sure. Okay. 50% retracement. Massively key psych level. Monthly central pivot. Lamborghini Mercy. I got. How does it go? I got. All right. What else? Pissy? Yeah. This is a great pair, by the way, pound Swissy. I know we haven't done it much since Brexit, even early days of Brexit, but this is an old friend of mine that, I'd like to reintroduce to you. Pound Swissy is a great pair to trade. Less noise than the Euro Swissy, and of course, greater volatility than the Euro Swissy. And when it works really good. So if you're already in a pound dollar, pound yen trade, the third one is going to be pound Swissy. And sometimes pound Swissy before pound dollar, right? So it can go pound yen, pound Swissy, pound dollar, depending on the time of year and all that kind of stuff. So let's kind of change this. Okay. Okay. You see anything here? So let's just define this. Okay. These are weekly swing trades only for bulls. Okay. Only bulls, only bullish trade plans, and only swing trades. Okay. Pretty nice, right? Okay. I don't like Euro Swissy in my, but I don't like it anymore. So it's not my thing. You can have it. Right? I find that currency pair stained, or at least for me, disdained. Lamborghini Mercedes. So Kiwi Swissy. Kiwi's so weak right now. It's just not something I'm gobbling up quite yet. We could look at piggy pairs. Piggy pairs. Okay. Piggy pairs. We got some support here. Okay. Got some piggy pairs there. Okay. And we have a defined top. Okay. We'll do it this way. And maybe some up. Okay. The high of the year, February 23, or is there a higher one? No. So the question is, are we, on a more macro level, are we looking at it this way? You know what? Let's not do trend lines. Let's do it this way. It comes down to your belief system, right? You have to make decisions. So you make decisions on what you believe is to be true. Do you believe this is a 618 Fibonacci retracement? And will we make it to the 1382 in the future? Dude, Barry, are you going ballistic today? Holy smokes. No. Oh, I thought that was Barry. Maida? What are you doing? Maida's gone crazy. Wait, no, it's Barry and Barry. It is. It's Barry, Barry, Barry. Maida, Barry, Barry, Barry. You guys are going crazy. What do you... No, it can't be right. I didn't see the upper part. What's going on? Yeah, it's hard because my eyes are so blurry. Tom Fords are still on the way. You're not... Well, I thought it said Maida, then Barry, Barry, then Maida, Barry, 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 Barry. Ah. Huh. Streamlab error? Yeah, I didn't see the actual post, so it's a bug, I guess, huh? Well, anyways, thank you for everything that you do, Maida. And thank you to Barry. It's a hack. I don't know nothing about that. It doesn't look like I got any money, so that's fine. Glitch in the matrix. Yeah, it's the bot. Too bad I didn't say. Oh, Barry sent you £2 million. That'd be great. Like, thanks, Barry. £2 million. Thank you, Bear. Hey, how'd you like those cigars? You got the Boulevards, didn't you? So anyways, do you believe in that, and are you trading it? It's pretty simple. Not too complicated. What do you believe? Because there's a reverse fib there if you're a bear. But I'm not a bear, so that's that. Lamborghini Mercedes. Wherever I go, we go. When we go, it's pronto. You're like, wow, Kanye. That's some epic writing. All right. Nice. Come on, Barry. Bring it. Now. Settle down, y'all. All right. All right. Okay. Noki, do we want to do pound Noki? No, not really. Euro pound? Not really. Yeah, I don't really want to go more than that. Pound what? Pound Noki? No. Pound yen? Yeah, let's do a beast analysis. Let's go beastly. We can do position trading bullish bias. And, okay, that's what we wanted on the beginning of the month. Now you're saying, wow, we missed it. Okay. Okay. All right. So that's that. What else? Then we can incorporate and change it again and say, well, even if you missed it, I think you would confirm that you're bullish. All right, great. So now we go to swing trading bullish bias. And this is what's occurred this month. Okay? So this is a buy zone. Looks like Monday, Tuesday, and Wednesday had opportunities. Here's the buy zone right on Monday, exactly where you'd expect. And if you're still a bull, y'all, all you all, then you're going to consider this. Let me change the color to try to match. Oops. You're going to consider this a buy zone probably today. Pig dog, I did it already. Barry, I did it already. Pound dollar? Already did it. I did it like 20 minutes ago. Yeah, you guys are moving the pound dollar. Okay, you see that, guys? Remember, we're not interested in this week's zone because we've already done this week. We're interested in next week's zone. So you would be looking at the world through the lens of the future, and it would look something like that. What do you think? Okay, what do you think? Okay, it has to do with, well, where do you believe we are in the process? Okay, because what we didn't mark was where is the out. So let's go back to, let's do it this way. Let's go back to indicators. Let's go set this up for the month. Okay. So this is the exit zone. So to carry out your analysis, what you're saying is, you know, if we're not going to use pivots and all that kind of stuff, let's do this. Let's just say somewhere around here. Okay. And somewhere around, where is it? Let's do it that way. You would have to make the determination whether you're going to use that as support, okay, in a move like this. You know what? Let me do a pitchfork on this thing. I knew I did that wrong. whole thing backwards. What am I doing? Struggling with it. I guess that's kind of where I'm going. I'm going to fit this so this is what I wanted to do. All right. Great. So your belief system is down and up. Okay. There's this, and then there's this. Riding off that moving average. And we call that also a role reversal, because they're all kind of doing the same thing. Okay. So your belief system would be based on riding this up, either aggressively or conservatively, inside of some sort of channel. I want to kill the pitchforks. I always find pitchforks too subjective. So let's do it this way. Let me add some more data. And then let me throw down a ray. Oh, there's no ray on this? Why did I think there was a ray? Levels. Huh. This one doesn't have a ray. Anyway, so you want to continue that into the future. So it would end up looking like this. Okay. So this gives you permission now to like buy these dips as a bull. And then of course this is your exit for March. Okay. Okay, neato, right? So how do you use that? Let's do something different now. Let's dive in even further. So we did monthly, weekly, back to monthly, and then let's go to daily now. Daily bullish bias. And drop into a 15-minute chart. And what do you want to see? Well, we opened out of position. Okay. Right? So there wasn't a buy this morning. And if this holds, what we'd like to see is maybe a day that kind of sets up a move tomorrow, meaning Monday. Edward, I marked that as the exit zone. Oh, was that it? I misclicked? Oh, sorry about that. I clicked the moving average instead of, yeah, that can happen. Very easily. Regression channel properties, yeah, of course. Thank you, my bad. Boop, 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 boop. Okay, so we'll switch out. And are you buying dips or what? What's your plan? One of the big things we talked about yesterday in our swing trading group is, are you going to buy the dip? Do you feel comfortable with the drop? Are you so certain you're right that there's no way you can be wrong? Will you buy a double bottom? Will you give up? Will you buy a dip? How much emotion do you have attached to, being right versus being in the trade? Because on the long run, we know we're right. That's what analysis is. You know you're right on the long run. So it comes down to, is this the right price and the right time to invest? And you know you've done your work, so you know you're right. So the issue is just simply time and price. Okay, cool. So what if you got the right price on Monday, but the wrong time on Monday? Are you okay? Would you buy a dip? And sure enough, we got a dip today. Are you still a buyer now? Are you freaking out? Is the sky falling? What's your plan? And then when you look at things like Aussie yen, right? Check this out. This is the weekly buy zone. This is the weekly exit. It's not really, right? It's not really a shock that we got some red candles. The real question is, are you a buyer down in here? Okay? But this being a top, you don't have to be a rocket surgeon to understand that one. So it's always about what are you going to do next, right? That's the aggressive entry. This is the conservative entry. What you going to do? What you going to do? Got a pocket full of pips, and my homeboys do too. There's your CAD yen, Oscar Mike. Okay. Here's a great example. This is technically OOP. So what's the trade plan? What does every swing trader know? Technically, this is a position trader, but okay, what does every single swing trader that has completed the swing trading course at FX Bootcamp? Wait for the pullback? Wrong. Buy the dip? So vague. What dip? What time frame? I mean, no. You can't be vague like that. Buy the 4-hour 21. Thank you, Jimbo. Jimmy's got it. Every single person that's gone through the swing trading course knows that like the back of their hand. Okay. So, you mean this? Yeah. Cool. So now we're hitting our monthly aggressive target. So 12 days ago, we said 87 is an exit. Doesn't mean it'll fall, but it does inform you what you're supposed to do. Some people don't know what they're doing. They're like, I don't know. I don't know what it's going to do. We have very clear rules of engagement. Now, one of the discussions we had last night in the swing trading group is how do you know to ignore this and go for April? And we talked about seasonality, profitability, portfolio management. There's lots of different decisions that go into it. If you're managing your own money, you might do one thing. If you're managing other people's money, you might do a different thing, because you can accept all your other risk, but in other cases you get paid to make profit. So maybe you profit here and rebuild the portfolio, all that kind of stuff. If you know. I know, like, psychologically, if you lost money last month and now you're making money this month, you are just screaming in your every bone in your body is screaming, take profit to pay for your loss, right? So there's a lot that goes into it. Ultimately, you have to make a decision. Okay? That, do you hold this until June? If you bought it earlier in the week, do you hold this till June? Maybe. Uche says gold nugget. Just take the training course. Right? There's hours and 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 hours advice like that. So you could look for gems, or you can just insert a credit card. Okay. Yeah, Crypto Miner says, if you hit the early in the month, right? Or in this case, early in the week. So this is a weekly move, right? So we're riding the 4-hour 21. This is probably your plan, or something to it. Or it opens up hot, in which you just buy the next move on the 4-hour 21. And then you say, well, Wayne, I got to hit a moving target, so you need to put a scope on this thing. Insert indicators, custom, zero lag, 21. I'd like to shift it 4 for the wind, right? And the Coriolis effect. You guys know the Coriolis effect? And it's this number that we're looking at here. We'll do it this way. Yes, I did, Pastor. Al Pastor. Yeah, it's there in the war room. Okay. So, nobody knows the Coriolis effect? Oh my God. How can you be a sniper and not know that? I'm probably mispronouncing it, and you're like, what the hell is he talking about? Coriolis effect. Yeah, so I mispronounced it. An effect whereby a mass moving in a rotation system experiences the force. Coriolis is what I said. So it's not that. Acting perpendicular to the direction of the motion and to the axis of rotation. So I have to adjust for that. Simple physics, yo. Okay. So that will be the number in the future. What does that mean? It means when people bought here, the 21 EMA was here, not touching it. See, not touching. It's lagging. It would have been here. And you're like, wait, Wayne told me to buy off the 21. No, I said you use that as support. It's a dynamic lagging support. Okay? It's a dynamic level of support lagging. You want to trade it where it is in the future. The future 21 is here. The current 21, let me change the color here. The current one is here. So based on this, okay, if there was a sharp decline on news and it would pop up, you'd be trading the future 21 now, and the lagging one will catch up later after a few candles. Okay? I call it cutting the corner. Okay? And you'll notice it's not much different from my 8 SMA. Okay? You could probably just change it. Okay? So you can just change it and say the 8 SMA, when you're using it, it replicates a 3 shift on the future 21. So you can kill this. You don't care about lagging 21. Okay? This is your fair market value. let's say you don't need that anymore. Okay. And you're trading your future 21. So you either use the 8, okay? But remember, in this case, the 8 is better in a bearish zone and better on a bullish zone. So then the lagging 21. So maybe that's why the combination works. I don't know. Whatever. If it gives you strength to get out of bed and do what needs to get done, then that's the answer. Okay? Cool. So peace on earth. May the pips be with you. May your profits be above average. Thank you. Have a wonderful weekend. Click the like button. May the pips be with you. Thank you for being on my team. Visit tradersway.com. Open a demo account. Thank you. Thank you to Barry Ameda for the small fortune. I appreciate you.